Okay, good morning everyone and welcome to this webinar on weathering the storm and planning for prosperity during these difficult times. My name is Sarah Glynn and I am Marketing Manager for Kuits. We are a commercial law firm based in Manchester City Centre. I will be facilitating your panel today, which consists, in addition to Kuits, with KJG Accountants, W&Co Financial Planning, Rowan Dartington Wealth Management, and coaching and training provider Make It Happen. So we're in testing times right now, and today our panel of experts will be coming together to hopefully provide you with some help working out a way forward, both for your business and for your personal finances and wealth. So I'm just going to be taking you through our agenda for today. I will start with just a few points on housekeeping, including how to ask a question. We will then be moving on to James McAvoy from Rowan Dartington, who will be talking to us about investing in uncertain times. We'll then be moving on to Chris Reed from KJG Accountants, who will be talking about some of the support that's available, not just for businesses, but for individuals as well if you're self-employed. Then we'll be welcoming one of my colleagues and partners in our tax team, Paul Bricknell. So he'll be talking to you about protecting your individual wealth and protections you can put in place, some of the trends that we're seeing at the minute due to the times that we're in, and also looking at protecting your business health as well. And then finally, we'll be welcoming Will Polston from coaching and training provider Make It Happen. So hopefully Will's going to finish with some uplifting and motivational presentation on helping us move forward during these times. So just a couple of bits of housekeeping from me before I hand over to the panel. You are able to ask questions and we will be coming to you at the end to do a short Q&A session with the panel. If you would like to ask a question, you just need to go to the bottom of your screen. There will be a Q&A button that you press. We've enabled you to ask questions anonymously. Obviously, there's quite a few sensitive issues that you might want to discuss, and you might not want to put your name to that or your business name. So please do feel free to ask an anonymous question, and we will come to you at the end. It's worth mentioning that this webinar is being recorded. I will be putting it out over YouTube and social media following the event. So just to bear that in mind when you are asking questions. And then following today, we'll be sending a follow-up email to all of the people that have registered. That will contain a post-event survey so you can give us some feedback. But we'll also be providing all of the contact details of your panelists as well. So don't worry about trying to scribble down people's email addresses and contact numbers during the presentation today. So without further ado, I'm just going to pass over control to James, who will be taking you through investment in uncertain times. Over to you, James.
Thanks, Sarah. Let's make sure we've got control there. Go back to slideshow view. Okay. There we go. So I'm an investment manager for Rowan Dartington, which is part of St. James's Place. The primary function of my role is to assist the St. James's Place advisors when it comes to designing bespoke investment solutions for their clients. I'm just going to talk to you briefly today on what's going on in the markets at the moment. We are in unprecedented times, but to put that into context over the longer term, and also touch on a relevant theme at the moment, which is responsible investment. So as we know, stock markets can and are unpredictable at times. This chart shows annual returns of the FTSE All-Share since 1986. Blue bars indicate years which we've had a positive return. The red bars indicate years where the returns have been negative. But the little orange dots, if you can see them just under the bars, shows how far the market has fallen from peak to trough during those years. And just to pick out a couple in particular, so 87, the market was down in that year 35%, but then ended the year up 8%. 2009, following the financial crisis, the market was down 21%, but then ended the year up 30% from its trough. So it shows that this short-term volatility occurs pretty much every year in markets, and trying to time the market can be quite difficult. And actually, most people can't do it and inevitably get it wrong, which is why it's very important to remain invested through these periods, even though it can feel very unnatural, because it's natural to be concerned, and it's important to stay rational and invest for the longer term. And the reason for that being is that we found that over the longer term, stock markets tend to trend upwards. So 74% of years we've seen positive stock market returns. So if you invest through the longer term, try not to jump in and out through these periods of volatility, you should be rewarded for holding those investments. Now, at the moment, of course, it's very different because we've got a lot of uncertainty, and that's because COVID-19 has brought with it something that we've not really seen before in our lifetimes, and that is the effects of lockdown and the ongoing effects that will have on the economy. So whilst stock markets hate uncertainty and always brings an element of volatility, what it does for an investor is it gives you opportunity. So there are a number of companies that we've wanted to invest in for a few years now that we've considered to be just too expensive, that we don't think they are good value investments at the time being. However, the recent period of volatility we've had in markets has allowed us to pick up some of these high quality companies that we've wanted to invest in for a while at a discount to where they've been trading in previous times. So any sort of volatility like this for an investor brings with it opportunity. However, what we've seen recently has been definitely different to what we've had in the past. So to put this into perspective, this chart shows how quickly the market has fallen in previous corrections. If you go back to the financial crisis of 2008, started in July of 2008, and it took 188 days for the market to reach its trough. With the COVID-19 market reaction, it took only 16 days. And in those 16 days, the UK market fell 30%. That's unheard of in terms of speed of a decline in a market. Almost half the time it took for the next quickest fall, which was back in 1929. Now, there could be a number of reasons for this. Like I mentioned earlier, this has been quite an unprecedented scenario. I think another factor is that money moves a lot faster these days. So even back to 2008, a lot less people had online access to trading accounts. Algorithm-based hedge funds were less common. So now it's not uncommon for a wall of money to be able to be shifted from one, like a long position to a short position, or sales of assets to occur in a very short space of time. I think the other contributing factor this time has been a lack of volume in the market. So when markets are operated normally and there are plenty of buyers and plenty of sellers, prices tend to average out. When we had the lockdown events occur, a lot of those market participants were suddenly not in the market. So then any sort of trading that goes on during the day exacerbates the price change, which is why I think we saw a much faster decline in values this time. So what can we be certain of during this period of significant uncertainty? Well, again, we need to look to history and think, well, what happened during these previous events? So if you look back to the global financial crisis, 2009, we had the Eurozone debt crisis in 2011, Brexit votes, the US election in 2016, then US-China trade wars and rising US interest rates in 2018. If we look at what happened after those troughs in the market, 3 months, 6 months, 1 year after, we saw recoveries every time. And if you look at the 3-year annualized figures, so the average return over 3 years and 5 years, post the financial crisis and the Eurozone crisis, those are healthy returns, markets returning to normal. So whilst we don't know what's going to happen after this market downturn, what we can be certain of is that at some point in the future, markets will recover. They always do. Longer term asset values will increase. And in fact, since the trough back in March, what we've seen is that in the UK market's up around 27% from that drop. So actually, it's recovered even quicker than these other instances in the past. Which is why it's important to be a long-term investor. Right, watch the tide and not the waves. So if you look back to 1987 or Black Monday, on this longer term investment chart, the UK market, it looks like a tiny blip now. Now, I can guarantee, I wasn't involved in stock market in 1987, but I can guarantee those people who were. It didn't feel like a small blip at the time. It felt like, the world was ending as we know it. But these things do wash out over time, and stock markets will increase in value. So I think it's important to not try to time the markets, remain invested and look to your long-term goals. Hopefully that gives you a little bit of a flavour on why it's important to remain invested through these periods and have a rational mindset. I just want to touch on a relevant theme at the moment, which is really come into play through the COVID-19 lockdown, which is responsible investment. We're all aware of the impact that humans are having on the world and the environment. And I think if you've seen some of the satellite photos from China, pre-lockdown and post-lockdown, the air quality above China improved, immeasurably in a really short space of time. So I think it's really brought this issue to the forefront of people's minds and the impact that we're having on the world. Now, it's a very complicated slide, this, but broadly speaking, the top charts show the effects of the growth of world population, GDP increase, how much energy we use, and how much water we use. And the bottom slides show the effect on the globe. So carbon dioxide levels, surface temperature, the level of acidity in the oceans. But all we're going to do is just look at the trend, look at the upward slope in the last 50 years. It's quite staggering how quickly these things are changing. And what's the main problem? Well, on the left-hand side, you've got global temperatures increasing. Again, this chart goes back to 1900. Last 50 years, human factors have caused global temperature rises, and we're all aware of this. On the right-hand side, though, is the atmospheric carbon dioxide concentration. This is a 400,000-year chart. And as you can see, carbon dioxide levels in the atmosphere go in a cycle. So peaks at around 300 parts per million, decrease again back to sort of 190, 180, and then increase again over a period of sort of 100,000 years cycle. In the last 50 years, that has spiked to around 400 parts per million. And it's human factors that have caused this. And it's causing a real issue. In 1970, we were using the Earth's resources about 1 times the time that the ecosystem could regenerate. By 2019, that had increased to 1.75 times. So we are rapidly consuming the Earth far faster than it has a chance to regenerate that. And in fact, if the whole world lived like Americans do, that number would be 5 times. That's clearly not sustainable. And it's important that we do something about it. And you can do something about it with an investment portfolio. Now, as with any change, as we've seen through industrial revolutions in the past, I think we are going into a new revolution of transition into a low carbon, sustainable economy. This brings with it investment opportunity, because clearly these companies that are going to be at the forefront, new technology, new areas of expertise, will hopefully provide investor returns moving forward. Now, how do you transition wanting to do things for the environment and things that are socially responsible into investment portfolio? Well, you can do things away from investments. So in your personal life, you could eat less meat, you could cycle to work, you could buy an electric vehicle. Nordea Bank conducted some research last year that showed that if you just moved your pension pot to a sustainable investment portfolio, it would have 27 times the impact, the positive impact, than all of those lifestyle changes put together, which I think is incredible. And the way we can do it through an investment portfolio is to screen a portfolio for different factors, both negative and positive. So on the left-hand side of the screen there is what we call the negative screening aspect. It's the things that we take out of the portfolio that might be environmentally damaging or irresponsible when it comes to society. So things like environmental damage, animal testing, primarily for cosmetics. We do include animal testing for medicine, alcohol producers, gambling, tobacco, pornography. You can only screen a portfolio so strongly. So with alcohol producers, for example, we just screen the companies that make it. We wouldn't screen out supermarkets and places that sell the alcohol, because you would end up with a very restricted portfolio. On the right-hand side of the screen is all the things that we want to do for the positive way of thinking. So what companies are involved in water management, in clean energy, and they might be, from looking at the company name or what industry they're involved in, it might look like they're sort of in a bad spot, but actually they are working really hard to make their business as clean and efficient as it possibly can be. So there's a whole number of different screens that we use to make sure the portfolio we produce for our clients covers all these bases. Now you might think that if we take out all those bad stocks and we invest in all these positive stocks, then what does that actually leave you with to invest in? And it would be a good question, because historically ethical portfolios have always been seen as highly restrictive. You're never going to get much return. And actually that's really not the case anymore. So even when we include the positive screens on top of the older style ethical negative screens, it leaves you a wealth of investment themes that you can invest in some really, really good companies. And I think these themes that are on the screen now are only going to get more prevalent as we move forward through time. And in fact, they're here right now and they're here to stay. So I think companies that accept that this is the way the world's going to go and engage earlier on are going to be favoured by investors moving forward. And just to finish off, going back to remaining invested for the longer term, not trying to time the market. This is one of my favourite quotes at the moment when it comes to markets, which is, be aware that the market doesn't turn when it sees the light at the end of the tunnel. It turns when all looks black, but just a subtle shade less black than the day before. And this highlights that stock markets don't wait for clarity. And they won't wait this time for economic figures to come through showing that the global economy is starting to recover from the COVID-19 lockdown. By the time you get that clarity, and a lot of investors did pull out of the market at the bottom and will wait for that clarity, the stock market will have already moved. It will have preempted that and already gone. So it definitely pays to remain a long-term investor in these times. I hope that was useful. If there's any questions, we can pick those up at the end of the presentation.
Great, thanks James. What a fantastic introduction to the topic. So I'm now going to pass over control of the screen to Chris from KJG Accountants. He's going to be taking us through some of the support schemes available for businesses. So for some reason that keeps happening, so I'm just going to get us back onto the slideshow, and you should be able to just click on the screen now.
Yep, there we go. So thank you very much, Sarah. I am Chris Reed. I'm one of the audit and accounts managers at KJG. We are a 6-partner firm, and we cover departments from corporate finance, corporate recovery. We have a payroll bureau, a taxation department which covers both personal and individual tax, and then a audit and accounts department from around about 1,000 clients, ranging from turnovers of 30,000 for what we would call a paper bag job, up to companies and groups of around 200 million. Again, varying different sectors: manufacturing, travel and tourism, retail, engineering. So that just gives you a bit of a brief outlook on what we do. The things we're going to be touching on today are sort of all the government schemes that you can actually see on that slide that have been introduced since coronavirus has hit. What used to be a chat with Dave down the pub, where he would tell you various different ways you could get money out of the government. Unfortunately, that luxury has been taken away from us at the moment. And it's a case of a volume of information coming out daily, which can be quite overwhelming when it's like I say, it's coming out daily. So hopefully we're just going to work through these various schemes, touch on them a little, and then if there's any questions that you may have in relation to any of those, then my email will be on the last slide, and we've also got the questions and answers section. So just going through them, we've also got the business support grant, the coronavirus job retention scheme, self-employed income support scheme, VAT payment deferral, bounce back loan scheme, the coronavirus business interruption loan scheme, and then the coronavirus large business interruption loan scheme. And one last thing is R&D tax credit. As you'll see, that everybody loves to shorten things now because we are all far too lazy. So there are various different acronyms there, such as C-bills and CL bills. So when you hear people talking about it, this is the sort of thing they are referring to. So we'll go through the first one. And if the business support grant funding. So this is based on the rates that you are paying to councils. So if you are a business and your business rates are less than £15,000, or you are eligible for small business rates relief, you're actually getting a one-off £10,000 grant from the council. So a lot of businesses will have already received this. If not, then get in touch with your local council and start the process of receiving that money. You don't have to pay it back. It is literally £10,000 in your pocket for the company to help with rates. Like I say, that's on rateable relief of around about 15k or lower. There is also then the option that if your rateable value is less than 51k but more than 15k, you are eligible for £25,000 worth of grant income. And again, that works in the same way that the council will make that deposit into your bank account. Unfortunately, if you are even a pound over the £51,000 rateable value, that then makes you ineligible, and they are not giving any funding out for that. So that just covers shortly the business support grant funding. We've then got the job retention scheme. Now, I'm fairly sure the majority of people will have heard of this in one way or another. So this is where employers can actually claim up to 80% of furloughed employees' wages with a cap of £2,500 per employee per month. And there are a couple of stipulations that need to be met for this. The employee that you're about to claim must have been on the payroll prior to the 19th of March of this year. So that's just trying to stop people that may want to add ghost employees onto payrolls and start trying to claim back £2,500 each for those. So yes, the employee must have been on the payroll prior to the 19th of March. The job retention scheme itself is set to run for all sectors until the 31st of July this month. Now, this is sort of a version 1 of the job retention scheme. There is now a version 2, which we're going to touch on the next slide, where it's going to be a bit more part-time with people coming back. There is more details coming out on the part 2 one on Friday, we believe. So we're going to give a little bit of a brief summary, but not too much detail about the version 2, just until we wait until what's happening on Friday. So then we've got the job retention scheme for directors. So originally there was no guidance on this. Now that they have said directors can be furloughed from a business. Now, a lot of directors, a lot of companies we deal with maybe owner-managed businesses where the director is the only person that owns the company and works for the company. So what they've said is you can still carry out your statutory duties as a director, even if you are on furlough. However, so things like that would include marketing your company. What you can't be seen to be doing is allowed to bring income into the business, because what they are saying is you are actually on furlough. Yes, you've got some statutory rights as a director, but you can't actively be bringing work in. You can market your company, but you can't bring work in. In terms of the money you can claim back, it works in the same way as an employee, which is 80% of the PAYE wages up to £2,500. And that's only on salary, that's not dividends. So when all this first came out, the government sort of covered off employees by having the job retention scheme, and then the self-employed, whereby they were going to give you a similar sort of amount, which we'll touch on in a moment, of your taxable income, your profits. They sort of missed directors out of owner-managed businesses, whereby they may take the base rate salary to get their employer's allowance and their national insurance stamp, but then claim the rest of their money via dividends. So unfortunately, that hasn't changed. So you can still only claim up to £2,500 per director, but you can't claim anything back if you generally take your salary as dividends. The director, again, must have been employed prior to the 19th of March 2020, and same thing, it's set to run till July 31st, and the part-time work coming up in expected months. So I mentioned the version 2 part of this. So that was all the version 1, and I'll say the version 2 part. The version 2 part is going to start on the 1st of July, which means the version 1 is going to close on the 30th of June. So employers will only be able to furlough employees that have been furloughed. Let me start that again. Employers will only be able to furlough employees that they have furloughed previously or currently for a full 3-week period prior to the 30th of June, if they are to be eligible to be furloughed on the version 2 scheme. Now, that full 3-week period prior to the 30th of June actually means if they have not been furloughed by the end of today for any point while furlough has been active, they will not be eligible to be furloughed in version 2, which starts on the 1st of July. So if anybody's thinking that they may want to furlough somebody into July and August, today is the last day they can actually furlough somebody that would then be eligible for that. And then, like we say, the flexible furlough can be used from the 1st of July, but that is something that more details are being released on Friday. So there will be an email going around to our clients and anybody that's on our mailing list. So if that's something you want to be added to, then myself or Richard, who is also on the panel, if you want to drop us a question or an email, we can add you to that list, and then we can make sure you get the information you require. So that's the job retention scheme version 1, which is ending in June, and version 2, which is starting in July. And again, the key date is today to make sure anybody that hasn't been furloughed, that you'd like to think about furloughing in July, is put on furlough today to cover that full 3-week period. Okay. And that's, again, just the notes of the what I've just said regarding the 1st of July 2020 can only be furloughed under version 2 of the scheme. Okay, so then we touch on to the self-employed people, and this came out after the furlough employees part of it. And again, this is 80% of their profits capped at $2,500 a month. So it's the same amount as an employee. And the way that is calculated is HMRC are going to look at the 3 previous tax returns that you have submitted and take an average of that. Now, your profits must be less than 50,000 to be eligible for this. And this is just trading profit. So when you're filling in a tax return and you've got your self-employed income, it's the trading profit from that. So if you've also got dividends and shares in a company that you then put on your tax return, because dividends aren't allowed, that then falls out. So it is purely the trading profit. If, for instance, you have not been self-employed for 3 years, you may have been working as an employee under 16, 17, 17, 18, and then decided to go and try and make it on your own in 18, 19. HMRC will still just look at your 18, 19 one then and say, right, okay, you made £50,000 in that tax year, you are eligible, and therefore we will give you 80% of the profits capped at 2,500. So that again is just how they are determining how much people will get. If people have any questions on how to access that or how to speak to HMRC or what the process is, again, if you ask myself or Richard, we can talk you through that if you've got any queries on it. Or again, ring anybody in our office in our tax department, and we can again talk you through the ways you can get that money. So that is your self-employed income. Back to businesses now. So we've talked about employees and directors and self-employed. For businesses themselves, things that were put in place, the first one being this VAT payment deferral. So everybody either has to submit generally quarterly or monthly VAT returns, depending on your size. So any VAT that was due to HMRC between the 20th of March and the 30th of June can be deferred. Now, this means that HMRC will not charge any interest on the payment that has not been made. As long as the VAT that you have deferred is paid before the 31st of March next year, then there will be, like I say, no interest from HMRC. The good thing about this is you don't need to be worried about contacting HMRC to tell them and spending the joyous 3 or 4 hours on the phone. You can just cancel your direct debit at the bank. If you weren't aware of this, and you may have made a payment in that period of March, 20th of March to 30th of June, you can actually now claim that money back through your bank under the DDI, which is the direct debit indemnity. So if you have made that payment and you think, you know what, we're now struggling, we shouldn't really have made that VAT payment on the 5th of May, then if you actually get in contact with your bank, you can get that money back. That doesn't still mean that you don't have to pay it further down the line. It just may mean that it eases cash flow for the next 2 or 3 months. But it is an option if you've made that payment and you think about, nah, I could do with that back. So it's something to think about. So that's your VAT payment deferral. Then we can start getting into the loan schemes for businesses. The first one is the bounce back loan scheme. So as it says there, loan of up to 25% of turnover, up to 50k. And the government are now saying, right, well, you can have your first year's payment free, and that the first year's interest is actually paid by the government. So that means then your repayable amounts start after the first year and can be up to over 5 years, 60 months. When it first came out, there was no real talk of an interest rate. It's now been decided that a sort of flat interest rate across all the banks of 2.5% is going to be accepted. So that is what the interest rate would be. It's 100% backed by the government, and it is a very, very easy loan to get because you're not having to produce forecasts or affordability assessments. So if you are struggling and you do come into this criteria, it is a very, very straightforward loan to go and get. And it's a very cheap loan at 2.5%, to be honest. So it would be something you would certainly think about. In terms of these loans that we're going to talk about on this slide and the next two, if you're not sure which one category do I fit in, which is the best way to do that, which is the best loan to go for, repayment wise, terms and things like that, then please feel free to get in touch. We can put cash flows together for you and look at your financial planning, come up with a bit of an action points and sort of say, right, okay, well, looking at the figures and what we think the market is that your set and sector you work in, we could go on a cautious side and say, right, we think this loan would work better for you. So if that's something that would feel like it would go over your head and you'd want somebody to sit down with you and just talk you through it and put you a bit more at ease, then again, feel free to get in touch, and we can go through those sorts of things with you. So that's the first one, the bounce back loan scheme for quite small companies, but it is a cheap loan and it is very easy to get because you're not having to do the forecasting or affordability assessments. The next one is the CBILS, Coronavirus Business Interruption Loan Scheme. This is for loans of up to 5 million. And again, the first 12 months is interest and any fees are paid by the government. So you can have this loan term up to 6 years again. there is also, you've got loans, but there's also overdrafts and invoice financing terms that you could go down. And the terms for that would be up to 3 years. So again, that falls back on the, well, do I need a loan, or could I potentially sell my debtors and do invoice financing, and that may work out cheaper? If you're not sure, feel free to ask. But the invoice financing and overdraft terms are 3 years, whereas your loan terms are 6 years. If you want to spread the payments out, you go for your loan. So the government are providing the lenders with a guarantee of 80% of each loan, to try and get the banks to start loaning the money with a bit more security that they're not going to lose out. For any facility that you're taking out under £250,000, you're not having to put up a personal guarantee, which is good, because generally that's where the stumbling blocks are, where shareholders aren't willing to put up personal guarantees. So if you do need something under 250k, then you're not requiring a personal guarantee. If you do need to put down a personal guarantee, though, you cannot use your principal private residence. So basically, the house that you live in on a day-to-day basis, or the majority of the year, you're unable to put that down as your personal guarantee. But yeah, to recap on that one, loans are up to 5 million. Again, your first 12 months are interest-free. And then it splits into, do you want a loan, which will be a 6-year, or you're looking at overdraft and invoice financing, which will be the 3-year period. You then go on to the slightly bigger one, which is the large business interruption loan scheme. And now this is pardon me, loans of up to 25 million, which is relevant to businesses turning over between 45 and 250 million. You can then also get loans now of up to 200 million, which was previously 50, for businesses turning over a minimum of 250 million pounds. So these are the big boys that really need this cash, or the airlines and people like that you see in the news that are getting millions and millions of funding, which is made up of these loan schemes, the furlough amounts and things like that. Their loan terms are up to 3 years. Again, the government's providing the lenders a guarantee of 80%. The personal guarantee of under 250k, you can still be a very large company and only require the 250k. It doesn't mean you have to take a very large loan out, which will then mean, you don't have to put a personal guarantee up. For facilities of 250,000 and over, claims on personal guarantees cannot exceed 20% of the losses after all recoveries have been applied. When we're getting into these larger numbers, this is something that requires a lot more in-depth thought and conversations about the best way for accessing these loans without the least collateral damage. So if you do fall into that category, we can put you in touch with our corporate finance partner at KJG, who is dealing with our larger businesses like this on a daily basis. So we can give you the best advice possible. So that's a brief summary of the large business interruption loan scheme. And then finally, is something that a lot of companies don't think they're eligible for, but in fact they are, is research and development tax credit claims. So if you've developed a product or a process, you will more than likely have something you can claim back under the research and development tax credit. And how that works is, for every £100 you spend on research and development, you actually get that £100 as a relief for your corporation tax, but you get a further £130 relief on top of it as well. So it is a really good way of reducing corporation tax. And you can actually go back 2 years. So if you're at a position now where you think, oh, that's something maybe I could possibly claim, speak to us, have a conversation. talk us through what it is you're doing, and then we used to come out and see the process. We can do that via a Teams call and things. But there is more often than not something you can claim back, and you can go back 2 years. So that would help, again, reduce corporation tax. You can take a refund, or you can create a credit which you can then use against future year profits. And the good thing about this at the moment is, because historically R&D tax credits used to go on for quite a while, and HMRC would scrutinise them quite heavily. Nowadays, I've pledged that 95% of all claims are going to be turned around in 28 days. So if you're thinking it's worth one phone call to open some dialogue, talk through the processes, you could be getting £230 worth of relief for every 100 that you've spent, and that will be turned around in 28 days. So again, it's another way of bringing cash in for something that you may not have thought of previously, for just making that one phone call and saying, well, this is the process, this is the product I'm looking at making, and what I've spent on it. And there could be some more money coming back to you. So again, like I say, if you open some dialogue with us, talk us through it, we can look to try and get that claim in for you. And providing HMRC keeps their pledge, it will be turned around in 28 days. So that is a brief sort of overview of what these schemes are. If anybody's got any questions or queries, you can feel free to ask them in the question and answer. Myself and Richard will do our best to answer those for you. Or similarly, KJG, find our details on the website, give us a call, and we will see what we can do for you. Okay, I hope that was all helpful. Thank you very much. I'll hand it back to you, Sarah.
Sorry, Sarah, I think I had handed over control to Paul there, but obviously, again, we're having a bit of an issue with the slideshow. So let me just get you set up again, Paul, and then you can, there you go.
Okay, good morning. For those of you who don't know me, I'm Paul Blicknell, and I'm a partner in the sort of tax, trust and will planning team at Kuits. For those of you who don't know Kuits, we are a full-service law firm based in Manchester City Centre, although we have clients all across the country and across internationally as well. We focus primarily on owner-managed businesses, family businesses, high net worth individuals, and property developers and investors. And what I'd like to talk to a little bit this morning is protecting wealth from a private client perspective. But I will also just touch on the end at some of the things that some of my colleagues are seeing being quite active at the moment. So starting off with protecting your wealth, and very much what I'm going to talk about today is based on what we're talking to about clients at the moment on a day in, day out basis, is the things that are concerning most clients and what the work that we're undertaking for them. And the starting point for that is clients making sure that they have wills and that those wills are up to date. So, you know, clients often, they start a business, they start a family, they're employed in good jobs, and wills are one of those things I'm going to do in the future when I'm older, when I've got more to think about. And I think one of the things we will say to everybody is that regardless of age, regardless of your personal situation, having a will is one of those things that everybody should do. Why? Well, the starting point is if you don't have a will, you have what's called intestacy, which means that you lose control of what would happen to your assets if you were to die, and effectively the government rules then control them, which might mean that everything goes to your wife. It might mean that not everything goes to your wife. It might go to wife and children, wife and parents, wife and siblings. Simple example would be if you've separated from your wife but not got divorced yet, assets would pass to them, or obviously the other way around with husband as well, would pass to them, notwithstanding the fact that you're no longer together. So having a will gives you control. And the control is important because for some people, they want to keep it very simple. It might just be a case of everything going to wife on first death and then everything going to their children on second death. But for other people, it might be a more complicated situation. They may have young children. They want to decide at what age those children inherit their wealth. They might have young children where they want to decide who's going to look after those children if they can't look after them themselves. And the appointment of guardians is sometimes as critical as dealing with the financial side. They may be supporting parents and need to make sure that support goes on after they've died. They may also want to have a greater level of control over children's inheritances if their children are going to inherit significant wealth. I've always said that if I'd inherited a large sum of money at the age of 18, I'd have bought a fast car and wrapped it round a tree. And many clients find that as their wealth grows, they get more concerned about how a significant inheritance at too early an age will impact on a child. And we often talk about the Paris Hilton effect of nobody wants Paris Hilton as a daughter who has no understanding of the value of money. And so some clients want to defer the age at which the children inherit to a later age than would be set by the law, which is 18. And some clients might choose 25 or later. And I've had clients choosing ages of up to 50, or even not letting the children have the capital at all, but simply only letting them have the income from their share of the pot, with the capital passing on from generation to generation as that family wealth grows. The other major thing we find with clients wanting control is where people aren't married. And you have to remember that if you die without a will and you're not married with a long-term partner, that long-term partner has no immediate right to any financial provision, even though you may have been together for 10, 20 or more years, have a house together and share finances. And the only way that partner can get provision is if they end up going to court or having to do a deal with the family of the person that's died to have financial provision made for them. So are absolutely critical for long-term relationships to have for people to have wills. But what we're seeing more of now as well is second and third relationships, and situation where you have a second marriage for husband and wife where they both have children from first marriages, and they want to ensure that their wealth passes to their respective children, either on first death or if there's not sufficient assets to go around where everything can pass to their children on first death, making provision for the survivor of them, but still ensuring that their assets pass to the survivor, to the first to die's children on second death. And it's a big issue because I have been approached in the past where someone said to me, my stepmother has just died. She's left everything to her children, but that's not fair because she inherited my dad's estate. To which my response was, yes, that's not fair, but there's not a lot you can do about it. And so it's absolutely critical where you've got second marriage situations that proper thought is given to not only making provision for each other, but also making provision to ensure that your wealth passes to your children and doesn't pass to the other side of the family. Apologies for just having a quick fire alarm test, but that's absolutely fine. I'm still staying. So, absolutely it is critical for so many reasons to have a will. The other critical reason to have a will is that often having a properly structured will can mitigate inheritance tax. So inheritance tax is charged potentially at 40% on your assets when they pass on your death. But there are a lot of exemptions for assets passing for spouses, exemptions for passing of trading businesses which you own, exemptions for money passing to charity or agricultural land. And so it's absolutely critical that a properly drafted will take into consideration those assets and the reliefs that are available to make sure that you're minimizing the tax that's payable as assets pass from one generation to the next. But the other problem, of course, is that what happens is people put in place a will, but then think I've done it and I can forget about it and never think about it again. And we get situations now, and again, it's funny how COVID has prompted people to look in the safe at their old will and think, I did this will 15 years ago. I've been divorced since then. I've married since then. I've had children since then. And you've got to think about those life events that make you want to review your will. So we always say review regularly, and I would always say between 2 and 5 years, you should review your will regardless of whether anything major has happened to trigger that review. But on top of that, getting married automatically revokes a will. So you may have a will from 10 years ago, you got married, well, that will, you might as well just rip it up and put it in the bin because it's not valid. So you do need to make sure you review a will in that situation. Having children, as I say, making sure you've got guardianship provision. You may have done your will before you had children and you've not put your mind to what would happen if something happened to a husband and wife at the same time. A significant change in your assets. When you may have done your will originally, you may have been employed in a well-paid job, but since then you've quit and you've started your own business. As I say, that business may be exempt from inheritance tax, and so it's critical to build that into your will to make sure you're making the best use of those tax allowances. And if you've had significant inheritances or other sources of wealth come to you so that your assets are much more significant than they were when you did your will, that's another reason to make sure you're reviewing it, to make sure it's up to date and is fit for the purpose for which you put it in place in the first place. So, as I say, the take-home message from that is have a will and make sure you review it regularly. Now, wills deal with what happens if you die, but powers of attorney deal with what happens if you don't have mental capacity. And we're finding again during COVID that it's something that's come to the forefront, mostly for elderly clients who have had to self-isolate and suddenly realise they can't get to the bank, they can't do this and they can't do that, but also become concerned about their health. But actually, again, when I'm talking to clients, powers of attorney become relevant for everybody. If you've got a situation where a business owner has developed COVID and has ended up in hospital, you have to ask the question, well, who's running the business while they're able to run it themselves? And so having a power of attorney whereby you grant somebody else the power to look after your affairs for you is absolutely critical, both for people older and are more likely to need it traditionally, but also in the current environment where there is a realistic chance that you may be incapacitated for a short period of time. And there's two types of power of attorney that we generally look at. Traditionally, we've said to clients, you need a lasting power of attorney, which is a power of attorney which continues even if you become mentally incapable. And there are two types of power. One that covers your finances, which allows your attorney or attorneys to look after your finances if you can't look after them yourself, to make financial decisions, to vote your shares in a company, pay your bills, etc. And to basically allow your finances to continue even though you can't deal with them yourself. And there's also then what's known as a health and welfare power, which allows people to make decisions about what medical treatment you get. Now, that might be about where, for an elderly client, where they go into care or what medication they're given. And ultimately, there is a box on the form that allows you to give the power to your attorney to make decisions about whether or not you receive life-sustaining treatment. And it's something that when we talk to clients, whilst it's a morbid subject to talk about, it's something that I think most clients see as a necessary evil. One of the problems we've got at the moment with lasting powers of attorney is to be able to use them. They have to be registered with the court, and typically that takes about 8 weeks in normal circumstances. But we're finding this is being pushed out to 13, 14 weeks at the moment, as the court's staff are all working remotely and they're just not efficient as they would be working from home. And so as an interim measure for some clients who need a power of attorney, but are worried about that 13-week, you can also do what's called a general power. Now, a general power is more useful, not where you lack capacity, but for example, an elderly client who just can't get out to deal with their own affairs. And a general power doesn't need registering with the court and is effective immediately. It can be used exactly the same way. It can be used on a financial basis to do anything that the person who's given the power would normally be able to do themselves. The one point to make is that it doesn't survive incapacity. So if you became mentally incapable, the power would cease to have effect and you would have to have a lasting power in that situation. But as a stopgap measure, whilst you're waiting for the lasting power to be registered, if you do need one, the general power is effective. But the one thing I'd say about general power, though, is it only covers the finances. It doesn't cover your health and welfare. Now, unfortunately, we get approached with clients who don't have powers of attorney in place. And in that situation, if they then become incapacitated, the only option is to apply to the Court of Protection for somebody to be appointed as what is known as a deputy. And that is a long process, can normally take 3 months. And we've not done one recently, but I can imagine it's going to take a lot more than 3 months at the moment, given the fact that you need a medical report and you need, again, the court process, which will be much slower than normal. So whilst if unfortunately we've not got a power of attorney in place, there is a route. It's not a route that we should rely on if we can get a power of attorney in place now. For many people, obviously, tax planning is the last thing on their mind at the moment because COVID has reduced finances, put pressure on business and everything else. But we do have a number of clients who are in a fortunate position where they have significant assets and probably more than they need. And one of the biggest barriers for them normally to try and mitigate future taxes is the fact that if they're trying to avoid inheritance tax by making gifts, because their assets are all standing at significant gains, they can't give assets away without triggering a capital gains tax charge, and therefore it's a barrier to future planning. So sometimes for some clients, depressed asset values, whether it be the stock market being down, whether it be property prices being down, or the value of their business being down, there is an opportunity to tax plan around depressed asset values. This might be the ability to give away an asset that has historically stood at a gain, but now is standing at a neutral position, so they can give it away without triggering a tax charge. It might be taking an investment company that has significant gains in it and reorganizing it so that you create a growth share over that company for future rebound value, which you give away maybe to your children or grandchildren, so that the future growth, when we bounce back, sits with the children, not with you, mitigating your tax. It may be for property investors looking at the property values and looking at how they can mitigate future inheritance taxes by reorganizing their property portfolios either into a company if they're held personally or reorganizing that company. We've also talked to clients who aren't ready to give assets away but have been trying to mitigate the change in taxation of buy-to-let properties, where over the last few years we've seen an attack on buy-to-let investors with taxation, where they see their tax bills going up for those that hold the properties in personal names. And for many, we encourage them to put property into companies rather than have them personally held. Now, for some clients, we can do that without triggering any tax charges at all, but for some clients, it's not possible. And again, taking advantage of the depressed asset values to push property into companies may have significant long-term tax benefits. So it may be a good opportunity to review that. So I just push those two on. The other thing we're talking to clients about is clients who have their own businesses, and you often get clients who are effectively a one-man band but operate out of a limited company. So they are the sole director, the sole shareholder, and they are concerned, similarly to the power of attorney point, they are concerned about how the company would operate if they became ill. As I say, having a single director day to day is great for us, for a sole trader business where, they don't want interference from anybody else. But if they become ill, having no capable director at all can cause a significant issue. And so we're encouraging clients who are a single director of their businesses, whether they be trading or investment businesses, to consider appointing a second director, so that if they become incapacitated, that second director can continue to run the business for them. And similarly, if the client were to die, that second director can continue the business without any issues. Similarly, if you've got a single shareholder and matters being dealt with by directors require shareholder approval, an incapacitated single shareholder is going to cause you an issue. And that's where, going back to the power of attorney point, as I said before, it's critical that where you're in that situation, you've got all your shareholders have powers of attorney to be able to let somebody else vote their shares for them. That doesn't just apply to a single shareholder, but where you've got anybody who has sufficient shares that they, without their shares being available to be voted, there wouldn't be enough to carry a shareholder vote. I have had a situation years ago where I had a client who had a property investment company with about 40 buy-to-let properties in Rusholme for students, single director, single shareholder. And in the March, he'd had a stroke and had no power of attorney. And his wife had to apply for the Court of Protection for her to become his deputy. And it took about 3.5 months. And in that period, all the student lets for the following year had happened. But because she didn't have the power to sign the leases on his behalf, they missed out on the opportunity, and they had a complete year of no rental income coming in because they weren't able to let their properties. So it is absolutely critical. It's a perfect example of where what's a relatively simple document in terms of a power of attorney, or if she had already been a director of the company, would have prevented a significant loss of income for them. And finally, I just want to touch on some of the conversations I'm having with my colleagues across the firm on the issues that they are seeing coming up most regularly at the moment. We're obviously seeing a lot of employment issues. As furlough, as Chris touched on, starts to wind down, the payments start to reduce, and the availability there's going to be a greater obligation on employers to contribute towards furlough. We're now seeing employers who had hoped that maybe by the time furlough was over, business would pick up and they'd be able to bring all their staff back in, are waking up to the realization that they are going to have to make people redundant. And we're having questions around, if you're going to put somebody on their notice period now because you are having to make them redundant, how does the redundancy process work? Can you use the furlough payments from the government to pay the notice period of somebody who is going to be made redundant? And similar questions. So, obviously we are here as a firm to support those businesses which are going to have to make some very tough decisions about the continued employment of a number of members of staff. Obviously we're seeing insolvency work, and again, there's a big crossover here between what we do and what the likes of KJG will do, where they have insolvency practitioner within the business, but we obviously offer legal support on insolvency matters, and that work has unfortunately significantly increased. And whilst a lot of banks are holding fire on pushing businesses over the brink, it's only a matter of time that some businesses will get themselves into trouble. But because of that, we're seeing a bit of corporate mergers and acquisitions activity, where those businesses which do have cash and are in a sound financial position are seeing opportunities to buy businesses which are getting into trouble, trying to help rescue them, doing deals. And we're seeing, there is opportunities out there for those clients who've got funds available or can raise funds to actually do some very good deals and hopefully help save some businesses from insolvency if at all possible. And finally, for me, the other area that we're seeing a lot of work around is for property landlords and tenants in trying to agree rent deferral, rent holidays, debt deferral for those property clients who've got debt, both in relation to residential and in relation to commercial property. And with these things, what often happens is with smaller landlords, with smaller tenants, they have a conversation with the client and they say, with their tenant, and they say, oh, well, we'll give you 2 months off. And it's not quite clear whether that's 2 months where you've got to pay us back later, or it's 2 months and that's going to be it. And the thing we would say about property deferrals and holidays is to document it properly so it's very clear what you're agreeing to and how long that agreement is, because we are concerned that there will be a lot of disputes coming up in 2, 3, 4 months' time where it wasn't quite clear what had been agreed. And the other issue, of course, is that some tenants are just simply not paying their rent without agreement with the landlord. And we're dealing with a lot of issues for landlords where they're in a situation where they can't simply agree to having their rent deferred or having a holiday because they've got to service their debt or they've got other overheads they've got to cover. And therefore, we are going to see litigation around enforcement of payment of rent where tenants have tried to avoid it. So we are seeing, again, if you've got issues around that, around those sorts of points, give us a shout and we're happy to have a chat through with you and see how we can help you. As Chris said, I'm happy to take questions at the end if anyone's got anything that they have touched on or not touched on that they would be interested in. Thank you.
Thanks, Paul. So far we've had a very holistic presentation really about really practical things that you can be doing to help you in your current situation, while also obviously keeping an eye on the future as well. Next, we're really delighted to welcome Will Polston from coaching and training provider Make It Happen, and Will's going to be talking to us a little bit about maintaining a positive mindset. So over to you, Will.
Sharing some insightful presentations so far. Sarah, can you give me the ability to share my screen and then I can just whip my slides up if that's okay, please?
Oh, of course, yeah. 1 second. There you go.
Wonderful. Let's see if I can make this work nice and quickly. Where's the... That's your screen. I need to be able to share my screen now. Meeting controls. Let me see if I can do it now. Yeah, it says that it's disabled.
We love technical difficulties on these webinars, don't we? Are you able to present without the slides, Will, and just take us through them?
Well, I can do my best. There's any issues that there's a lot of visual stuff that I was going to be going through. Okay, in participants, if you click participants and then click more under me, it should just say make host. I think you might be able to do, and then I can just share my screen from there.
There you go. Is that better?
Yeah, perfect. Wonderful. Then that should continue.
There we go.
Looks like we are working. Wonderful. Okay, so yeah, good morning, everybody. My name's Will Polston. I'm a mindset strategist, and yeah, I'm looking to share some new knowledge with you today. I've just had some great, really insightful presentations on some of the real practical parts of what we can be doing in businesses, but what I want to talk about some of the more soft skills that we can be using to help us in this challenging time. So, like I say, I'm a mindset strategist. I predominantly work with entrepreneurs, leaders, and ambitious professionals to live purposeful, inspired, and energized lives. I'm the youngest British male member of the International Coaching Federation. I've spoken at TEDx, I blog for the Huffington Post, and I'm also a member of the Association of Professional Coaches, Trainers, and Consultants. For me personally, I sort of immersed myself with learning anything to do with personal development, studied heavily in neuro-linguistic programming, obviously coaching, but then take it to other extremes by studying the likes of quantum physics, laws of the universe, studying from some of the smartest people in the world, like Dr. John Demartini, who for me is one of the leading authorities in human potential and human awareness. and not only learning the theoretical side of things, but also putting it into practice as well. So putting myself through sort of pretty rigorous challenges. This is when I summited Mont Blanc the other year. Everest is in the pipeline. That'll be happening in the next couple of years. So yeah, being able to apply these things and put them into practical real world situations, as well as just understanding the theory. In terms of my company, Make It Happen, which is a coaching and training company, we have 4 growth zones, so belong, grow, accelerate, and qualify. But everything that we do is centered around my whole coaching methodology, which is clarity, action, and accountability, which we touch on very quickly in a moment. And there's quite a number of different things that we do with people from all different walks of life. But in terms of the specific content and what I wanted to go through with you today, a couple of key things that I think will be beneficial you can implement straight away from today. So first of all is a formula that can change your life, which is events add response equals outcome, or E plus R equals O. So events are anything that happens externally to us. Obviously, coronavirus is something that's impacted us all right now. That is an event. That's something that's happened. But what we have is we have a choice whether we react to what's going on, we react to these events, or we can choose to respond to them. So reaction is something that we typically do as an impulse. It's something that would typically be driven by our amygdala, which is sort of our reptilian brain, whereas a response is a conscious decision that we choose to make. So we use our forebrain, and then we're able to make a decision that we want to make that's going to benefit us. And the beauty of this is that our response is what determines our outcome. Now, there will be things that happen in life that are not our fault. And we say it's not our fault, but it's always your responsibility. And the reason it's always your responsibility is if you take the word responsibility, it's your ability to respond to whatever's going on in your environment, whatever's happening. You have the choice of how you choose to respond to it. And I'm going to give you a tool and technique of how you can do that in just a moment. The other thing worth bearing in mind is the formula for happiness. So happiness is equal to or greater than your expectation. If your expectations are met, you're happy. If your expectations aren't met, you're unhappy. And in its most simple form, by understanding this, what we can do is we can start to understand what we can do to increase our happiness levels. Now, a lot of people just say to me, well, does that mean that I need to lower my expectations? Do I just bring the bar down? And the answer to that is no, we don't do that. But what we do is we change our perspective. If you change your perspective, you change your world. If you can imagine that the square and the circle, the pink square and the blue circle are shadows, if we were shining a light on that cylinder there, but we're looking at it from one angle, we'd be adamant that the shape is a circle. If we were shining it from the other side, we'd be adamant that the shape is a square. Now, whilst the shadow and the square are true, they're not the truth. The truth is that the shape is a cylinder. So what we need to understand is that our perspective can sometimes be an illusion, and it's not what's actually going on. There's a difference between reality and actuality. Reality we create. We have the ability to have a very different reality. Every single person is having a different reality. If we were all sitting in the same room, which we're not right now, the temperature might be, say, 18 degrees. For one person, they would think the room is cold. The other person, they would think the room is hot. The fact is that the temperature is 18 degrees, but the reality that each of us are experiencing are very, very different. And in really challenging times like what we're experiencing right now, this is absolutely key. This is absolutely fundamental to being able to take a different perspective, see things from a different light, to give us a better experience and be able to meet our expectations. So one of the ways that we do that is by understanding that we need to create balance. And the way that we create balance is by looking at things from a different perspective, but we look at things from a different perspective, from a quantitative and qualitative perspective. So if you can imagine, so on this example you can see on the screen, on the right-hand side, imagine you've got a brick on the balance scales. Now, obviously a brick is a lot heavier than a few grains of sand. But if we keep adding grains of sand, eventually it's going to balance out. So at the time when we're adding all of these tiny little small positives, and looking for the small positives in what might be deemed a really challenging negative situation, we think it's not having an impact, but it will get to a point where we keep adding all of those tiny little benefits that we can see in what's a challenging situation, and eventually we'll be able to get to the point where it's it's neutral, and that's really what we're looking for. So one of the key things that I go through with many of my clients is that most people would say what they really want in life is to be happy. I'm sure you've said that at some point in your life. What they really want is to be happy. Whereas I don't believe that what people really want to be is happy, because if you're happy, it's one side of a perspective. So everything in life's on a spectrum: good, bad, happy, sad, positive, negative, you name it, all light. It's all on a spectrum. Whereas what we ideally want to be is in a state of gratitude. To be in a state of gratitude is a state of unconditional love. So if we're seeing something as bad, by finding the good in that bad, then that puts us in a position to find strength. So using coronavirus as a prime example here is, for a lot of people, it's been bad for business, but there will be areas that it's been good for. So it'll be good for training in business. They can do more training. It's good because they've been able to work on the business. They've been able to re-strategize. It will be good for their family life, to be able to spend more time with the kids. For some people, it might be the opposite, and it's been more of a challenge for them spending more time with the kids. But the point being is that if we look in different areas of our life, we'll be able to find what the benefits are. We'll be able to weigh them up. So we can look in the 7 areas of life. Whenever you've got a challenge in one area, you can look in the other 7 areas. So spiritually, physically, in terms of your family, in terms of your career, in terms of your own attitude. We can start to look in terms of your relationship. You can start looking at all of these different areas and start to see what the benefits are in those areas. Then what we do is we go a layer deeper. So to add more grains, if you like, to the balance scale, is we look at what's the primary benefit, the secondary benefit, and the tertiary benefit. So what's the benefit of the benefit and the benefit of that benefit? What that will do is it will enable us to have depth and be able to cultivate true gratitude and see things from a completely different perspective. So if something's occupying a lot of space and time in your mind, if it's something that you're thinking about a lot, if it's something that's particularly annoying, and you're having some form of emotion that's triggered, then working through this process, it will enable you to see things from a different perspective, and most importantly, create a different feeling. There's a lot of science that goes behind this. I'm not going to go into too much detail about all of the science today, but there's a part of your brain known as the corpus callosum, and the Latin translation literally means human tough. And the beauty of this is it's the part of the brain that connects the left and right hemispheres of the brain, and it's the part that creates balance. And this is essentially what we're looking to do. If you use this process that I've just mentioned, the cultivating gratitude process, you will be unbreakable. You will literally be an incredibly tough human, because you're not going to be at the mercy of your own emotions. You can control your destiny by being able to put yourself in the strongest possible position to live a sort of a state of gratitude and live at peace, which again, in these challenging times, it's something that's hugely beneficial, because then you can make much more logical decisions and do things that are going to benefit the medium long term, rather than just the short term because of an emotional impulse. Something I wanted to share with you all, which you can get access to literally using the bit.ly link there, and I'll send it to Sarah afterwards, is a positive psychology intervention. So if you're someone that's going through a bit of a tough time right now and things maybe aren't working as well as you would like, then I'll send a resource. It's a 3-week positive psychology intervention where you just do an intervention. It takes 5 minutes on a Monday, Wednesday, Friday for 3 weeks, and it's proven to have an impact on your psychology and how you feel. So I can send that over and you can work through that. So yeah, it's been great to share some insight with you guys. Hopefully it's been beneficial. One thing that I'd love to just finish on and say is that I truly believe that the actions that you choose to take today will have an impact on other people. It will impact your family, your friends, your community, society, humanity, the universe, as a result of the decisions that you choose to make today. And those decisions that you choose to make are going to either have a negative impact, or they're going to have a positive impact. And I know that deep down you want to be able to have the positive impact. So I encourage you to be a boulder, not a pebble, have that positive impact, have that ripple effect, and be able to make a difference as a result of applying some of the things that we've just spoken about. So that rounds up everything from me. Thank you very much. If you want to connect in any of the different social platforms, then please feel free to, and I hope you have a fantastic day.
Thanks so much, Will. I think we all feel positively uplifted there. So thank you for coming in and sharing your wisdom with us. We'll move on from there to questions. Will, if you'd be able to kind of pass the hosting back over to me. We did have one question that came through via email from one of our attendees prior to the webinar this morning. So I'll start with that one. Paul, I think this is probably for you. I want to help one of my children get on the property ladder. Am I better gifting or lending her the money?
Yeah, it's an interesting question, that, because I mean, that's one that we've had that question a number of times from clients over the last few months, where for one reason or another, children have been looking to get on the property ladder, and either because, you know, banks are finding it a little bit harder to lend, or because parents sort of think it's the right time to get children on the property ladder. They've been asking about, you know, do we take a share in the property? Do we just buy it in the child's name? Should it be a gift? Should it be a loan? And I think the simple answer is not one size fits all. We generally discourage the parent taking a share in the property because it can lead to significant adverse stamp duty, land tax costs, and also other tax issues down the line. The balance, I think, between lending and gifting is two issues. The one is, do you need the money back? You know, is this your retirement fund that you're just lending in the short term but need it back as and when you stop working, or as your finances run down? And I think the answer to that is, if the answer is yes, you need it back in the future, it's a loan. It has to be a loan and nothing else. If the answer is no, I don't need that money back, then I think it comes down to, are you happy to give it away? If you've got more than one child, can you afford to make the same provision for all of them? Because you can't make a gift to one, then suddenly realize when the second one comes knocking at your door, you can't afford to do it again. Do you want to have some form of control over that property, so that if you don't want the child to be able to then sell it and run, you know, go on the round the world tour, or remortgage it and use the funds to buy a fast car or whatever, you know, how much control do you want? And it's things like that that will impact ultimately on, is it a gift or a loan? The answer is it can be either. We can structure it as either, and it's very much down to personal circumstances.
Okay, fab, that's brilliant. So I don't think we've had any other questions that have come through, so we'll end everything there. Obviously there will be a follow-up email that will go out. Obviously, if you want to ask any more questions to any of our panelists, you will have their contact details to do so afterwards. But I'll just leave by saying thank you very much to all of our panelists today. We hope you've enjoyed the content and found it beneficial, and we will be sharing the recording of this following the event to share with other colleagues or contacts that you think might benefit from the content. So thank you very much, and have a great day.